Hey, good morning, everyone. Marty Mazzori here. It is Thursday, the 7th of March, with your end of week market snapshot. Clients, you'll get it attached to an email tomorrow as Friday's message. Going to keep it pretty quick this morning. Really, nothing's changed of note on the technical setup for equities. But we'll look at it again. Nevertheless, we'll look at the dollar, look at yields. We'll look at gold again since I brought that one up the other day. But first, I want to talk about sentiment. My, oh my, folks are bullish. On your screen is the AAII bull sentiment in green, bear sentiment in red. And you can see that is quite the gap between these two right in here. Rivals the gap we saw heading into the year. And folks, this is a contrary indicator as everybody gets crowded on one side of the boat. A little bit of news that might suggest that's a dangerous side to be on. And if it sends everybody running in the other direction all at once, it could have a pretty notable impact on the market in question. So just going back here, heading into 2022, I know we've done this before. You can see we had a pretty good gap, and we ended up with quite the bear market there for most of the year. Heading into 2023, and I mentioned this the other day, that analysts were very bullish heading into 2022. Wall Street analysts, they were very bearish heading into 2023, and you can see what the market did. It's hard to talk about 2023 without talking about the massive concentration in a small number of stocks, but nevertheless, it did propel the index notably higher. So yeah, that's somewhat concerning. Perhaps the market needs a catalyst, but I would say that the potential, and you'll see it again in the charts, for something that folks would feel to the downside certainly is in the present setup. And while I say that, the S&P is up like 0.87% this morning. I listened to a bit of Christine Lagarde's European Central Bank address this morning, and generally I think the market can count on mid-year rate cuts, all things being equal. Chairman Powell is speaking to Congress as I speak, and clearly he's not saying anything that's upsetting the stock market apple cart, so to speak, at least at the moment. As for investment advisor sentiment, a very important sentiment read. It's amazing how often these things play out as they warn right here. The latest highs in strong tech buying advanced the bulls to 59.4 from 57.6 last time. That exceeds their recent highs for the most bulls since summer of 2021. Remember what happened in 2022, folks. That increased the danger of a retreat. High levels of optimism are danger signals. The bulls last exceeded 60% in April and then July of 2021. And you can contrast that because it works the other way as well. Remember, we were pretty bullish short term at the end of last year, and notice that in September of last year, the bulls fell below 43% as the market came down. In a bull market, readings around 40% indicate lowered risk to buy, but bulls above 55% are signals to prepare defensive strategies. And again, you can see where we are there. Bears declined to 16%. That's now their lowest count since summer of 2021. Remaining bears hold lots of cash. Many question the accuracy of positive economic data and still project a recession, and we're kind of still in that camp, folks. We also note more comparisons with the tech bull of 1999 and 2000 and so forth. Again, so low levels of bears. It was near 18% July, August of 2023 at just 15.3, and again it's 16 now. Hint at market tops. And again, we talk about that a lot. And then the bull-bear spread, which actually is a component in our own fear-greed index, is at 43.4, and 35 to 45 is clearly in the danger zone. And again, when it's low, like it was October of last year when we were short-term bullish, that's a bullish sign. You can see it's at the opposite extreme right here, folks. And then they make the point here, and I've said this as well, overvalued markets, bubbly, whatever you want to call them, can go for a very long time, even longer than weeks and sometimes months. But they say here that that we should recall that tops usually form over weeks and sometimes months, while bottoms can occur quickly in a bear market, such as in late 2022. So yeah, just because we're at these levels, clearly, and as you can see here, the market is continuing to melt higher amid really, really bullish sentiment. In terms of the technicals, your hourly chart, here we are now getting into new highs right here with quite the bearish divergences on the momentum indicator. That would be a caution sign. On the daily chart, still living in this range right in here. You can see we touched the bottom of the range here a couple of days ago. Boy, still have your bearish divergences. Still have a slight sell signal on here on the MACD. Again, not giving trading advice, but typically a trader would wait for that break of the trend line before they act. And then as for the Qs, the NASDAQ 100 Index ETF, I keep pointing out this rising wedge pattern. We're back to testing the bottom of the uptrend line right here. I got your very notable bearish divergences. Looks too much like the previous all-time high for comfort, and I suggested it feels that way as well when we look at the very bullish sentiment which we had back in here as well. Russell 2000, really nothing to report. Looks pretty much like the chart the other day. Did successfully test the 50% retracement from the recent high, still well off of that high. You still have your very noticeable bearish divergences, at least on the daily chart. As for yields, pretty flat today on the 10-year yield. Again, the way this market's been trading, declining yields would be bullish for stocks. That was certainly the case yesterday. Was not the case day before yesterday, as I talked about on that particular video. I mentioned that this is the kind of action that we will be looking for in a recessionary type setup for stocks. And I also said that I thought it was too soon to make that call. So while I think that hinted, and I talked about that this morning on the written blog, of what we may ultimately see, it does not seem to me that we're there just yet. So Tuesday was somewhat counter to recent trends, but it looks like we're kind of back to what the trading has been of late, and that is market responding to potentially weakening economy, but really discounting an immaculate soft landing before it's all said and done. And then the dollar. Dollar is broken below a falling wedge pattern. In a way, I guess you could say it extends that wedge a little bit. But anyway, I don't want to try too hard here on the lines. Right now, dollar is responding to prospects for lower yields going forward, Fed rate cuts, perhaps mid-year, and so on. And tomorrow's jobs number, as you can imagine, will be awaited with the most bated breath. And lastly, gold, because I mentioned it the other day. We're long gold in our core portfolio, so I'm certainly not complaining. And remember I said the other day, this could be, if we got some rotation, we could actually see this being one of those charts that, burns through these bearish setups, and we had a bearish momentum divergence here the other day, and you can see we're almost about to negate that here on the MACD. The RSI is very overbought right here. So folks, again, while we are bullish in a not small way, gold long term, I do expect that we'll see some give back from these levels. It certainly technically it does look like that. There's some speculation that central banks have been big buyers of gold of late, and that actually does make some sense to me. So we'll see how that plays out going forward. But look for lots of volatility in just about everything. And I can't reiterate enough how that sentiment data from a contrarian view really has our attention right here, at least in the short run. Folks, thank you, as always, for watching and listening. Talk to you again soon. Bye-bye.